Hello guys, how are you doing? Today we are going to discuss DeFi and real-world assets with the team of Fathom Protocol, and they are all three of them, Tyler Carter, Anton Grigorev, and Manuel Rensink. Great to have you all here.
Thanks,
Thanks for
Anton.
having us.
Yeah, so let me introduce you briefly Fathom, and it's a DeFi platform which provides liquidity solutions for both retail and institutional investors, and as well they have their own USD-backed stablecoin, FXD, which you can use to gain exposure to yield opportunities in the real-world assets vaults and trade finance pools. And today we're gonna know more about it. But first, let's discuss with you all how about your background and how did you generally get into crypto and more. So let's start with Tyler, maybe.
Yeah, happy to do it. So brief backstory, Manuel, Anton, and I all worked at a tokenization firm that focused mostly on institutions called Securrency. We all had senior management positions there, and we essentially were running DeFi projects aimed at building utility for tokenized real-world assets. So Fathom started off as a project there, and then we had the opportunity to spin it out under our own banner. Securrency got bought up by DTCC. So that sort of started this solo journey for us. Me personally, I did 2 years at Securrency. I was head of digital assets. Before that, I was head of digital assets at Standard & Poor's, where we built crypto ETFs and then also tokenized some real world asset products as well. Before that, came from the ETF business for a number of years and traditional asset management before that. Been in crypto since 2012. Actually got started beta testing some of the integrated DEX features on Ripple's XRPL.
Yeah, that's quite impressive and early. What about you, Anton? You're the most technical person on this team.
I hope so. So yeah, I started my developer journey working on an Satellite project. It was fun and cool. Then I ended up in finance as IT consultant. I can't say it was very fun and cool, but it was hard. I spent some time there, and then I got interested in Web3. So I joined the foundation division of one project, which this project targeted tokenization of RWA also, but in 2017, 2018. So I was more involved into writing crypto primitive stuffs, libraries, participating in hackathons, organizing hackathons. And then we, with some colleagues, separated from this project into the new entity, which is now named Metro Labs. So I was working mostly on ZK Rollup, ZK Sync, and in 2020 I joined Securrency. So there I was working more on the technical side again, building a rules engine, compliance framework for permission transactions on chain. And then we've been building a tool for middle office replacement to build loans, mortgages, and other financial instruments, different assets. And then, yeah, we started Fathom, and here I am.
And which year did you get into crypto?
I think it was 2017. Yes, 2017.
Okay, much later than Tyler. What about you, Manuel?
So I started out in TradFi in the city of London, which takes us back a while. I worked for a couple of investment banks, and then I joined a company called Riskmetrics Group, which was a JP Morgan spin-off. And with the Riskmetrics Group, I moved to Dubai, where I'm based now. And from there, they got taken over by MSCI, which is funnily enough a competitor of S&P, where Tyler used to work. And then I left MSCI, started working in a family office, did some crypto trading. I think this was back in 2014, 2015. And then I started working for a Swiss crypto exchange called Licky in 2017. So I guess that was my first real 100% crypto professional job. And then I joined this currency in 2018, where I met these guys. I was there for 5 years. And in September, we set up Fathom.
Yeah, that's impressive background of working with TradFi and institutional companies in the direction of digital assets. So my next question is, why did you decide to leave securrency, and why did you decide to start Fathom Protocol, and what is the idea behind it?
Yeah, sure. Maybe I can answer that. We decided to leave currency. Well, let's take a step back. At currency, the three of us actually set up a kind of labs entity to work on technology that was a bit outside of the bread and butter of currency. So a lot of clients would come to currency and say, "Hey, we want to tokenize funds." So they were talking to a lot of asset managers, for instance, like WisdomTree Asset Management. And currency was really good in tokenizing those funds and was really good in deploying compliance oracles. But then the question was always, okay, now a fund is tokenized and it's compliant. What to do with it, right? It's not as if there's like lots of liquid security token exchanges out there. So our plan was really to use DeFi as a distribution channel for those asset managers. So taking out a bunch of intermediaries and putting those assets straight into the wallets of retail users, for instance. So that was one important use case. And then the other important use case was more for asset owners. And these assets could be things like gold or real estate income revenue or treasuries, to collateralize those assets and borrow against it, and in fact borrow stablecoins against that. So that's what we started working on. We found ourselves a sponsor, and that was really the XDC network. They've been very supportive, and so with them we were able to develop Fathom on the XDC network as a blockchain, and to really kick off their ecosystem as well, their DeFi ecosystem, because they were running into the same kind of issues in that they were always very global finance and trade finance focused, but you really need to create this whole ecosystem of participants, and you really need DeFi as a distribution channel, and you need all these native on-chain financial functions. And so this is where we started off their DeFi journey, I would say. And what better way to do that with a stablecoin? So the first implementation of Fathom was based on the stablecoin FXD. It's a US dollar backed stablecoin. And then because currency was in the process of being acquired by DTCC in the US, which is the Depository Trust and Clearance Corporation, I think it stands for. It was a good moment to spin off at that time, and we reached a tripartite agreement, and we never looked back, and we're of course still very close to currency, and we think they're great on the tokenization part, and we're focusing more on these DeFi blockchain native financial functions.
Yeah, that's interesting. Tale, Anton, do you want to add more on that and on your activity at Fathom?
I think no. Means Manuel explained almost everything perfectly.
Okay, great. So let's discuss more your first real-world tokenization asset, your stablecoin, FXD. So we have already a variety of other different stablecoins on the market with the leaders USDT, USDC of Circle. So how is FXD different, and how do you ensure it's backing, and by which assets is it backed?
Is the question to me? I can answer,
Whoever
by the
wants
way.
to start to answer.
First of all, FXD is a stable asset, is decentralized, and it's over-collateralized and backed by XDC asset at the moment, which is also decentralized. For us, it's easy to make any other collateral pool, to make a mix of digital assets and eventually tokenized real-world assets contributing to its safety. But for now, it's only XDC, and it's really nice to keep it over-collateralized by decentralized asset. At least at this stage. So this ensures reliability. So yeah, about stability. So it is over-collateralized. We ensure, like the system ensure, not us, because we do not own FXD. Smart contracts ensure that FXD is always over-collateralized by its collateral. It means collateral value always exceeds the value of the second, a liquidation mechanism. It protects against the volatility of the market, the volatility of the underlying collateral. So we have a fixed spread liquidation strategy when the liquidator liquidates some part of the collateral if the price of the collateral drops below some threshold. We plan to improve the strategy. We already designed something that at least I call the dynamic spread tiered liquidation. This mechanism has some improvements compared to fixed spread liquidation model. For example, it has dynamic spread, it has dynamic loss factor, batch liquidations, possibilities of assets bundling, and so on. For example, batch liquidation we have right now. So yeah, and the third option, how we ensure the price stability is our stable swap mechanism. So we have a stable swap model. It allows us to exchange one-to-one FXD with another stable asset with very low fees, and it allows us to do the arbitrage with other DEXs on XDC network. And the last thing, protocol has possibility to adjust borrowing rates of FXD based on its market price. So it can encourage either minting of FXD or buying back FXD and repaying your debt to maintain the peg. So yeah, there are 4 base mechanisms: over-collateralization, liquidation, stable swap model, and adjusting the borrowing rates of FXD.
So is FXD backed by XDC, or is it backed by fiat, USD, by bonds, or by other stablecoins too? Or
just XDC.
So can we tell that it's algorithmic stablecoin in this case?
It is algorithmic because it's on-chain. There are smart contracts. It's not like USDT or USDC where you have some centralized entity where your money are sitting and you are minting the new stable coins when you have more money. We have on-chain asset. We say, hey, for example, we have this value of on-chain asset. We want to use it as collateral, and we will mint a certain amount of stable coins, which value will be lower than the value of its collateral. And we have algorithms that ensure that this value of collateral will be always higher than the value of FXD minted. So it is algorithmic, but it's it's based on the centralized currency, which is XDC. We do not own XDC, so it's pretty safe collateral compared to usage. For example, we could use, let's say, USDC as collateral, but then we will take some certain risks this collateral has. because, for example, USDC collateral has, centralization risks. Reserves may not be proved. For example, you need to prove the reserves, and actually nobody knows how big are reserves. And there are some speculations, for example, about reserves of USDT, for example. And we also do not use what Terra Luna used as collateral. We do not use our governance token as collateral. So we do not see it on the token of the protocol as collateral. We are using the decentralized asset as collateral. And we can adopt the new collaterals in the future. It may be either on-chain gold, for example. On XDC, we have Comtech Gold as collateral. We can use other types of collaterals, but at the moment, it's good for us to use just XDC.
So maybe in a nutshell, so yes, it's algorithmic, as Anton explained, but sometimes when people talk about algorithmic stablecoins, it's stablecoins that are backed by nothing, or that are backed by their own token, which was, of course, the issue with Terra Luna and the USD stablecoin. So in our case, it's yes, algorithmic, but it's over-collateralized by a crypto asset at the moment, and we can extend that to other asset classes, as per the DAO decisions, to other asset classes, and those will most likely include then very stable asset classes, income yielding asset classes like fixed income or gold as collateral for the stablecoin.
I can add a couple of additional sentences to it just to explain the people. For example, right now I don't remember actually the value of collateral we have. It's about 2 million, right? TVL protocol. So it means we have XDC tokens locked in our protocol, and the value of these XDC tokens is $2 million. And there is only, let's say, 800,000 of FXD minted. Means the value of FXD is 800,000. It's like more than 50% lower than the value of the collateral. And even if XDC token will, for some reason on the bull market, will drop significantly, let's say 70%, we will be in trouble. As protocol, not really, because what will happen, those positions which may be at risk of being under collateralized, let's say some person provided not enough collateral to keep his position collateralized enough, then his position will be liquidated. Liquidator will come and say, hey, I want to liquidate, let's say, 25% of this collateral, and we'll see if the position will become safe. If it will not, it will liquidate more and more and more. So protocol is designed to be always over collateralized.
Anton, you're predicting all my questions and already answering those.
In terms of uniqueness too, I'd also call out FXD's position in trade finance as well. So a lot of this is really like a product of working with XDC network. This is why we chose to build on XDC network, our stablecoin, and that was their inroads that they've made into trade finance. So we've run about, I think, 8 or 9 trade finance lending pools, meaning a lender can come in, deposit FXD, and then take part in returns from the underlying trade receivables. And I don't think any other stablecoin, even the big ones like USDC, have actually been involved in trade finance funding in the way we have been, even at this early stage. So that's a big differentiator for us. We do that in partnership with a company called TradeFinex.
As well, what's the ratio for over-collateralization of FXD?
133%.
So it will be always so, or will it be increased, or will it be less in the future?
It's the question, the Fathom DAO decides what will be the minimum over-collateralization, but it's like minimum. When you provide in the collateral, you can choose the more significant safety buffer. So you may decide to keep your position safer than this value.
So I gave the maximum ratio, I guess. You can choose, like Anton said, any ratio under that. But Yeah, there's potential for that to be adjusted. There's also potential for the DAO to decide that different assets or different collateral types get a different ratio of collateralization based on their, risk profile, essentially.
Thank you. And now you're on XDC network. Do you plan in the future the partnerships with more blockchains?
We are open to ideas since we believe in that interoperability is important for any chain. So if it contributes XDC network, if it contributes as XDC community, so why not? It's good. That's why we, for example, granted the prize to ZK Bridge project on the recent India hackathon. So we are making signals that we want interoperability, and maybe the Fathom will be a cross-chain protocol if it benefits the community of XDC and community of Fathom.
Do you currently talk to any blockchains about potential cooperation, or you're still focusing on development on XDC for now?
Yeah, I think right now fully focused on XDC. I think there's a lot of a lot to capitalize on there. I think it's, sort of been an underserved community. So the idea is to really, lean into them. And then if there's opportunities that make sense, cross-chain to bridge some value or some use to XDC, we'll definitely take that under consideration. But yeah, right now focused on XDC.
And as well, let's talk more about real-world assets tokenization, which has been quite a big narrative, especially since the last year. So what generally developments do you see in real-world assets tokenization, and where will there be the biggest demand for real-world asset tokenization? Will this be funds, trade, real estate, or anything else?
I think, this is an interesting question. I think real estate you've seen sort of get out of the gate in terms of RWA tokenization pretty quick. And I think that's due to the reduced barriers to spinning up a tokenized real estate investment. Obviously, what we're doing as a currency focused on tokenized securities, going through the full SEC approval process. When we were there, we actually got some of the first SEC approved tokenized funds over the line. But yeah, I think that's a longer journey. And then if you're talking to, like an ETF provider, like a BlackRock or Vanguard, and, you're talking about tokenizing ETFs or tokenizing funds to sit alongside ETFs, it's a bit of a longer journey. There's a lot of processes on the back end, not just the actual tokenization of the asset that needs to be figured out. But yeah, I think we're believers in, everything gets tokenized, coming from TradFi institution, especially coming from the ETF space. Very, very strong parallel between what happened with wrappers for funds in the sort of transition from mutual funds to ETFs. ETFs were just a technological improvement over mutual funds. They offered a host of new features. And see flows into mutual funds anymore because it's advantageous just to move into ETFs. I think our message is really that, tokenized fund wrappers are the next evolution above ETFs, and that they'll do the same thing to mutual funds that ETFs did to mutual funds.
And how many years do you think it will take to tokenize everything and to put everything on chain?
I don't know. I'm interested to hear Manuel and Anton's opinions. I think it's probably a 10-year plan, in my opinion.
Well, there seems to be a consensus at conferences, at least in Dubai, that by the year 2030 or so, that the number is between $30 and $40 trillion. But I don't know where that consensus comes from, but that's what all the smart people say.
It's a long road.
From technology perspective, it's easy. Yeah, technically it's easy. Means technically it's easy to do anything. So we are ready, I guess, a while ago, but it's a question to legals and so on.
But I think also the real question is, tokenizing something that exists in the real world, like an equity that sits on a completely different kind of database, and then tokenizing and putting that on blockchain is one thing, and that's probably less interesting for us and probably more doubtful in terms of value add there, because you're just adding an additional technology layer. But what I'm really hopeful of is that more and more financial assets, like loans, for instance, will be issued primarily or only on chain. and that institutions and banks will start issuing directly on chain, which would make everything so much easier for everybody involved, right? Everybody except, of course, layers of intermediaries that are now deducting their rents. So this would really benefit people in the real world, and that's what we're doing it for. Of course, pensioners looking for yields on their savings, or the small businesses looking for attractive financing, something they can't get, in most places in the world, even in the developed world, and to really, fill all those gaps. And Tyler was talking about trade finance. There's a huge gap there for small and medium enterprises that are not able to trade with counterparties abroad because they cannot get the trade finance, right? And so if you start issuing on-chain, if you start settling global payments with a stablecoin, you can, really disintermediate. Maybe not everybody. Maybe you will still use one custodian. But you can do all these transactions on one blockchain in a matter of seconds or minutes, instead of having to use maybe up to 10 different intermediary banks when you make a transaction between Brazil and Indonesia, which might take weeks and weeks, and even for large companies that have to maintain hundreds and maybe thousands of bank accounts around the world, right? You could replace that with one blockchain and maybe one custodian, and reduce time and cost for everybody in the real world, not just for DeFi degens.
Yeah, I remember even since at least 2018, there were happening so many security tokenization conferences. Big banks representatives were coming there, like Morgan Stanley, HSBC, JP Morgan, and etc. And they have been talking, but there were some really small tests and attempts to do something, but the real traction is only beginning now.
Yeah, and the focus is, and especially with US banks, of course, they've basically been told you're not allowed to do anything with public blockchains. So you have to do everything on your private. So everybody's just working on his own little intranet proof of use case, right? So that really doesn't leverage what blockchain can deliver. So that's that's all good development that's happening in the background, and maybe when there is more clear regulation, that work will still have some use. But in the meantime, I'm very skeptical of all these private networks and really blockchain. The big use case of blockchain is, of course, global transferability. And without that, there isn't much, there won't be much need or demand for these kind of private chain products, even if they can make it.
And can you tell us more about your real world assets vaults, and as well what partners do you have?
Yeah, definitely. So real world asset vaults are under audit, fully finished. So we're hoping to launch those in pretty short order. So essentially, what a real world asset vault means for a user is that they can mint FXD, or come with FXD that they've acquired on a centralized exchange, deposit that into a vault, and gain exposure to a tokenized real world asset. So we're lucky to have a few partners lined up already in the XDC ecosystem. One of those is called Yield Tech. They are, folks who come from trade finance, traditional finance background. They've tokenized 2 products thus far. The first one is U.S. Treasuries, probably not surprising to anyone who's watched that growth over the past, year or so. The other one is probably a little bit more interesting. It's going to be a invoice factoring trade finance token. A little bit higher yield than treasuries, and I think a very important piece of this ecosystem. And the other one that we're planning to roll out in short order is tokenized gold. So with a partner called Comtech Gold. But the idea is to really grow these vaults and get exposures across a diverse range of assets. So you could come and you could essentially do portfolio management on chain through Fathom. Rotating your positions between what you think makes sense given the current market environment.
So in your opinion, it will be more interesting for institutional investors, so traditional retail audience, because I guess for crypto people, the return will be too small.
I think it's important to hit both, and this is sort of like the ethos. Fathom was birthed out of a very institutional shop, but we saw that retail was the market that really existed now. So in our opinion, real world asset vaults service both those categories. I think your everyday retail investor certainly wants to come and gain exposure to tokenized real world assets. But likewise, you have any conversation with an institution, and yield is probably the foremost topic that they're interested in when we're talking about tokenized assets on chain.
And as well, I would like to return to the question about stablecoins and particularly regulation of stablecoins. So can you share more your opinion on that, and as well about potential stablecoins regulation in the US? And let's start with Tyler, since you're based in the US.
Maybe that means I should go last. No, look, I think we're hopeful for, I would say, a more open framework in terms of regulation. Certainly if you're watching the SEC, it seems like you have certain figureheads there sort of acting alone. And if you take a sort of a canvas of the entire SEC, certainly there are some commissioners who favor a more open framework that would, keep the US, in the lead globally in terms of innovation. I'm hopeful that this takes a course change over the next, 12 to 18 months. But certainly it would appear that would mean changing out certain officials to get to that spot. But when you talk to any like banking institution, of which the three of us have been doing it for a number of years, there's so much on the table in terms of value capture, either from automation, reduced error rates, or gaining access to new markets, cutting out intermediaries. I think, our opinion is definitely that this is going to be ubiquitous technology. Maybe there's a little bit of gatekeeping on the regulatory side on behalf of institutions right now, but I think this ends in the next 12 to 18 months, and we'll see a ecosystem sort of flourish around this.
And I would add to that most of the regulation tends to focus on the stable coins that are backed by deposits, right? By off-chain deposits, so the USDCs and USDTs of the world. As they should, I think, in my opinion, regulators should focus on where crypto intersects with the banking system. That's where they should focus on. So that means so-called CeFi, right? We saw a lot of CeFi disasters last year. Centralized exchanges that have fiat off-ramps. Broker dealers that are licensed, etc. So OTC desks that offer off ramps. That makes sense. That's where a regulator should focus. Now, if you look at our type of stablecoin, so FXD, or you look at something like DAI, although DAI is a less good example because they're also fairly centralized because their use of USDC. But in terms of our type of stablecoin, it is really a crypto token. It's really, in our case, it's the XDC token, but in a stable jacket, right? But it's fully collateralized by XDC, so it's just a different form of XDC. So that's a crypto token. That's an unregulated token, and that's the stablecoin itself. And then if you look at DeFi, I think that should also be largely that is not touching the banking system. That should also be largely left unregulated, or at least that there should not be any focus on that. And we haven't seen any focus on that. So even in the US, you have, for ages you've had Uniswap there, and you have Compound there, and you have Aave there, and these protocols manage billions and millions of dollars, but they don't touch the banking system. When people try to take the money out and put it in the bank, that's where the regulator should look at. So I think, most stablecoin regulation will focus on these off-chain backed stablecoins as they should. And there's several issues with that. I mean, you have stablecoins that say, well, we're 100% backed, but are they? Maybe it's 70%, or maybe that's not even the biggest problem, right? So in the case of USDT, it might be 70% backed, or 80, or 90, or 100%, but also it is managed by a small team, and forget the backing, that team just could walk away with it all, right? So that's a huge risk, right? And so, in my opinion, only a matter of time for that to either, for these decentralized stablecoins, to either be crushed by, on the one side, decentralized stablecoins like our own, and on the other side, CBDC slash commercial bank stablecoins. I think they'll be stuck in the middle, or something much worse happen before that happens. So yeah, right now we are seen as non-systemic, as we should. And in fact, I think, you know, governments, regulators, policymakers should see non-systemic stablecoins as an opportunity. We see that now in stablecoin land. I don't know the exact numbers, but I'm guessing something like 95% plus is back to the US dollar. This is actually, you know, value locked away to issue US dollars. The whole world is using it. Why is this the case? Why not have still Japanese yen and UAE dirham there as well? Why give all that value to one jurisdiction? So, and we've seen these initiatives, and we've seen the Central Bank of England, you know, deeming this kind of stablecoin to be non-systemic. We've seen the British government actually quite, you know, in favor of decentralized finance. So we're quite kind of hopeful. And then there are other initiatives with World Trade Organization, where they're looking for a non-sovereign stablecoin that can be used in international trade, that doesn't fall under the jurisdiction of, for instance, the SEC. SEC thinks, of course, that everything falls under that jurisdiction, but might not be that everybody agrees with that in the rest of the world. So I'm actually quite optimistic on the future of decentralized stablecoins versus these off-chain backed stablecoins that, in my opinion, actually do require, you know, a lot of regulation and supervision.
You mentioned that we shouldn't really focus on the one jurisdiction. So do you plan to launch in the future of Fathom Euro, or Fathom, for example, GBP, or Fathom Dirham, or other stable coins?
Yeah, I would love to see our DAO split up into different sub-DAOs and have you know, all the currencies of the world in there. So yeah, sure, but it'll be driven by the community, in the first place, the XDC ecosystem, and then beyond that, right? So it's not ours. The protocol is not ours. It's decentralized. We cannot make these decisions. We don't even have the voting power. Yeah, we just hope, as we mentioned, that other jurisdictions, other currencies will follow and start eating away at that US dollar stablecoin market share.
Yeah, and can you share as well some other plans for the future development of Fathom Protocol?
Yes, quite a lot. If we will talk about like short-term development plans, it's improvement for our DEX. In the first place, we want to improve our stable pairs. Well, we don't have stable pairs there yet, so we need to adopt the technology to have the stable pairs there with advanced mechanism to maintain the price stability. Also, the vaults, as we discussed before, we want to give our community, you know, some automated investment strategies to gain yields on crypto assets like FXD deposited by the users. So, well, speaking more about the vaults, it's not only about RWAs, it's also about the trade finance. It may be also some other strategies to gain yield. But of course, it's also about RWAs. So, for example, we can give non-direct access to RWAs with them. For example, I have FXD, stable asset, which is kind of cool. I can deposit it into the vault, and the strategy will give me an opportunity to utilize this FXD. So the strategy will, for example, buy some RWA for me. Well, let's say I think we mentioned before about the trade tax. So they have this USTY asset, which is like a tokenized US Treasury bond. So the strategy, for example, can buy USTY for the user and gain yield on it. So this kind of development we plan to release quite soon when we pass the audit. Also, we plan to create the full-scale lending. We want to keep, as I mentioned before, FXD for now over-collateralized only with XDC, because we want it to be over-collateralized by really decentralized currency. As long as possible until the DAO votes for something else, let's say. But we also want to make it like we want to onboard real world assets into the protocol to fulfill our promise. So with full-scale lending, we will be able to use, let's say, Comtech Gold, or this is TY asset or whatever else, to borrow other assets, and for example, to make a secondary borrow of pre-minted. It's like about the short-term plans. I hope we will see those releases before the summer this year. Midterm plans include oracles powered by FXD, which is kind of cool. I'm not aware of like any other oracle where you can pay for the data using stable asset. Usually you pay in protocol token. So we already have some sort of development past and some sort of readiness of the technology, but we need to do more development, more testing, etc. So it's like we use those oracles internally, but we need to productize them during this
Let me
year.
just interrupt for a sec, Anton. So important distinction. We're talking about real world assets being used by institutions, right? Which means they all need a real world asset oracle. No corporate treasury is going to be holding crypto assets. So if you're not using an oracle that runs on stable coins, which is something they can wrap their head around, they're not going to hold crypto assets on their book, which is how most oracles operate now, right? So important distinction. And as Anton said, puts us really in like, a category alone at the moment.
Do you think
Yep.
Chainlink
Thank
can
you,
be a
Tara.
big competitor since they as well already work with institutionals, with all these banks? So they may offer in the future payment for them in stable coins too.
The crypto market is still in a bit early stage, let's say, and I think like other competitors, it depends. For example, we don't have Chainlink on XDC. So
Let's
yeah,
just hope that
competition
Chainlink
depends.
is not listening to this podcast.
Like that's look, they built one way and maybe the reality is
yeah.
different, so they can assess those changes on their own. But look, it's obviously an issue. They've tied Oracle use to their token price, right?
Yeah.
So it's not
And
so
look-
easy to swap out to a stable coin, in my opinion, at all.
And to build on what Tyler just said before, it's especially for institutions, of course, but for any business, right? You want predictability in your costs. So if you pay for market data, you want to know what that's going to cost, and that you shouldn't have to pay for that in a volatile token. So it just makes a lot of sense to have these things be paid in stable coins. We think that will be quite innovative, but if other protocols also take that on, I mean, that's the beauty of DeFi, of course, is its composability. So everybody's building on top of each other, and we've certainly done that as well. And we look what is good, what we want, and then we leave out what we don't want. And that's just the beauty of DeFi ecosystem, and that's what allows everybody to develop, so fast, right? These development cycles are measured in months, not in decades, right? As you have in the off-chain world. So and especially in the financial world, it's really like decades, centuries even. So we're all good. We are cooperative. We're imbued with the DeFi life motto of live and let live and help each other, and so if that takes on traction, I don't see why it wouldn't. I think it's better for everybody, and so also for us.
Do you have anything else to add on what's next for the Fathom?
I think for 1 year it's enough. Long-term plans are not like certain for sure, but I can just tell as a tech guy I want to work on something interesting. So it may be a lot of the things. Let's say, for example, some privacy solutions, dark pools, so like privacy layer. We'll see. Also, we as tech guys actively exploring the new techs. And for example, all this new AI narrative, and there are like some applications in crypto also involved, in Web3, I'd say, not in crypto. For example, AI-driven governance. It may be interesting, or AI can be also used in the products like direct indexes, which is also maybe interesting for us to help people to manage their portfolios and the yield strategies. A lot. Fathom is some core technology, which is FXD, but we can have a lot of building blocks on top of it.
Tyler, do you have anything to add? The last words?
No, I don't want to stress the team out if they're listening by adding roadmap items. I think that's plenty.
Okay, great.
I would just add one thing, and one thing is the technological roadmap, but what Tyler and myself are focusing on a lot is of course liquidity. I mean, that's vital. Without liquidity, everything dies. So that involves getting custodians on board, getting brokers on board, getting staking providers on board, off ramps, centralized exchanges. And to keep building and start building this network effect, both for the lending protocol as well as for stablecoin. So that's where a lot of our attention goes, especially Tyler's and mine. And we see good traction. So knock on wood, we'll have some interesting updates over the next few months, and so we encourage everybody to follow us on Twitter for those updates.
Yeah, so we'll wait for the more updates from you, and hope to see the TVL of Fathom growing, and to see much more use cases and much more partners who are offering the yield from real world assets tokenization and more. Thank you for the great discussion.
Thank you.
Thank you, Anna.
Thank you.